The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
As stocks reaccelerate towards those all-time highs, the U.S. economy is showing signs of decelerating towards cycle lows. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Alex Steele. And records from Microsoft, Google, and Amazon.
That's right, and that's why you got the NASDAQ near a record high.
No fanfare, but yet that is happening. All right, let's get a check-in here on the markets. S&P flat on the day. On an index level, it's pretty boring out there, and volume's super light, but underneath some interesting things are happening. I mentioned Amazon at a record high, Microsoft as well as Google. Chewy up 3%. That doesn't really tell the story intraday. Super fun, though. You had Roaring Kitty just posting a picture of a dog on X, and Chewy, Petco, those stocks really soared. We'll get to that later on in the show. That's just pretty fun to talk about. And the 10-year yield, a little bit bid here. We had the 5, the 7, and the 2-year this week, and it went pretty well. Therefore, solid demand today for that 7-year. Romaine.
Yeah, yields right now holding where they've been for a good part of the day, and that is a flip lower. You see that on the benchmark, back down towards that 200-day moving average as that inauspicious picture of U.S. economic growth got a little bit muddier this morning with the trifecta of dour data points. Orders for factory equipment unexpectedly down, jobless claims hitting the highest since 2021, and pending existing home sales, those are down to the lowest level on record. Some Fed officials have actually been warning about this for quite some time. Concerns about the state of the real economy. San Francisco Fed President Mary Daly saying the job market is near an inflection point. Chicago's Austin Goolsbee warning of too tight monetary policy for too long. Stuart Paul over at Bloomberg Economics also seeing headwinds with consumers spent beyond their means and now looking to exercise more restraint. You got a taste of that in that guidance out of Walgreens earlier today, which showed, at least at the retail level, not a lot of folks are spending on discretionary items or impulse purchases, at least not at Walgreens. A shift of shoppers over to Walmart, over to Amazon, over to other discount retailers. Walgreens CEO Tim Wentworth telling analysts that customers are now increasingly being much more price sensitive, Alex.
But yet they'll go on cruises. I mean, what's the macro read? It is a little confusing for me. All right, let's get this chart here. This goes back to the previous point that Romaine was making in terms of the data just coming in really lumpy and not great. So the bars here represent the economic surprise index. So when it's green, it means that you're getting upside surprises, red, downside surprises. And the white line here is the 2-year yield. And I just want to focus in on what's happening over here. So as you saw in 2023, the data continued to surprise to the upside, yields moved higher. Right? We're going to see higher for longer. The Fed's not going to cut. The economy is doing really well. Now, you saw a little bit of a dip in yields as the economic surprise index paired some of its gains earlier in 2024. But now we have negative economic surprise index. As I was mentioning, the data keeps pretty lumpy, but yet yields are kind of sticking around 4.71%. It raises the question, are we going to wind up seeing money coming into the bond market, particularly on the front end, and lower yields and kind of this gap fixing itself a little bit as we look forward to some Fed cuts, or am I just completely off base at the end of the day, Romaine?
All right, well, now 57 minutes until those closing bells. Let's get some answers out of our first guest, Mike Contopoulos, Director of Fixed Income at Bernstein Advisors, helping to kick us off to the close. And a lot of talk here about the direction of yields. They've kind of been holding where they've been for quite some time, but I think we've seen those bouts of volatility over the last few weeks, whether it's on the back of the Fed, the back of some of these earnings reports, or the back of economic data.
Yeah, that's absolutely right, Romaine. I mean, I think you're going to continue to see a pretty range-bound market, though, until you get some real movement on the economic front. I mean, the data has been a little bit weaker for sure, but it's been a little bit of a comeback, I think, from unexpected strength to start the year. So the economic surprise index, as Alex mentioned earlier, highlighting maybe a few stress points, but I don't think the market's fully convinced yet that, we're headed towards any sort of imminent recession or anything of that.
What about this idea here that rate cuts might actually be back in play? I know most of the Fed members are kind of reticent to really go down that road because that's all anybody wants to know here. But when you look at the economic data, I would think a case can be made.
I would maybe take the other side of that a little bit. I mean, if you came from Mars and you saw sort of the holistic picture of the economic landscape, GDP now is tracking at about 3%. Inflation is still above 3%, and you're really rolling over easy comps. And inflation could start to see that go up come June. You're probably not going to ask when's the Fed going to cut. Mm-hmm. Now, I'm not saying they're going to hike. I think that would be premature. But with that said, I'm not sure the obvious cases at this point that they're going to cut. Yes, we're seeing normalization from exceptional strength to start the year, but is it really bad data? I'm not entirely convinced, and we're not at 2% yet.
Right, and that's such a good point, because it's normalization versus slowing, right? And they're different things in essence. Are you more worried about growth or inflation than at this point?
In terms of the upside or the downside?
Ooh. If you were sitting on the Fed, which would you be more concerned about?
I would be most concerned about a reacceleration of inflation.
Okay.
I mean, to start the year, we had miss after miss after miss on inflation to the stronger side. As I mentioned earlier, June really marked the lows in inflation. You're going to start to overlap June pretty soon. That's going to cause upward pressure on a year-over-year basis for inflation. And remember, coming into the year, everybody was saying that rent was going to ultimately lead to lower inflation. And what we've seen is the housing market has actually been quite resilient until recently. And so that is also going to continue to add price pressure at the headline number. And so I would be more worried that we're not restrictive enough at this particular point.
So you're more on like the Bowman camp versus the Daly camp in essence.
I agree with that. And all you have to do is look at credit spreads, look at what's going on with crypto, look at NVIDIA and the Mag 7. I mean, to say that monetary policy is restrictive at the moment, I think is really ignoring the macro data.
Is there, though, a disconnect between what we're seeing in the markets and what we're actually seeing in that quote-unquote real economy? And I mean, this is something that Bowman raised, even Bostic raised yesterday, and I think even Goolsby kind of touched on it as well.
I think, honestly, I think the markets and the real economy are pretty much in sync. I mean, you haven't seen a big collapse in yields because the data is pretty strong. You have seen sort of more speculative areas of the market recently run because liquidity is still easy. I think this idea that just because the Fed hiked, 500 plus basis points, that all of a sudden that magically means that they're restrictive and things should start to slow, maybe just suggests that the neutral rate is actually higher than what most expect. And so I think actually the markets and economic data are very much in sync right now. Liquidity is not tight enough. The economy is fine, and consumers still spending, and rates haven't fallen because of that. That all seems to jive with me.
How does that fold into the corporate debt market right now? Because we certainly didn't see the movement in spreads that I think some people had anticipated earlier this year.
Likewise. And I think at the end of the day, it all boils down to fundamentals. Fundamentals are strong. Undeniably strong from a corporate perspective. Earnings growth is accelerating. Leverage is, fine. Interest coverage is fine because so many companies termed out their debt during COVID and the immediate following years. The problem with corporate credit, as we see it, is valuation. Valuations just aren't attractive. I mean, 90 basis points in IG, 300 basis points in high yield. Remember, as that yield gap shrinks between a corporate and a treasury, essentially the majority of your return becomes from the risk-free component, not from the credit risk component. So if it's coming from the risk-free component, let's find some better risk-free or close to risk-free assets than corporate spreads.
Before I let you go, tomorrow, PCE, personal spending, income, what are you watching? What do you think you're going to learn?
Listen, I think we're going to learn how, not just tomorrow, but over the course of the next several weeks, we're going to learn how much of this is normalization versus maybe something a little bit more nefarious and a true slowdown. I tend to be, as you can tell, in the former camp, that more normalization, but I think that's what we need to...
What's the signal? So the numbers come out tomorrow and you're like, ooh, normalization or slowing. What would signal that to you?
Something that ultimately ends up much lower than consensus.
Much lower.
Yeah.
Okay.
Yeah.
All right. Fair enough.
Yeah.
Really good to see you.
Absolutely.
All right,
Nice to see you too.
Mike Contopoulos there, Director of Fixed Income over at Richard Bernstein Advisors. Stick with us. A lot more coming up here on the program, including a preview of the big presidential debate here in the U.S. later tonight, what it could mean, not just for voters, but for investors as well. Tina Fordham over at Fordham Global Foresight will be joining us in just a second.
All right. Plus, shares of Chewy spiking, followed a post by Keith Gale, known as Warring Kitty. We're going to look at what was in the post that caused the surge. Look at that chart.
Nike also reporting today after the bell. Investors awaiting details of new products and guidance for the rest of the year, and maybe another read on the health of the consumer. A lot more coming up here on the big program. This is The Close on Bloomberg. Thanks, Mike.
Thanks, guys.
Absolutely.
We think there's a big opportunity in credit.
There is huge investor demand.
Because the returns are higher, now everybody wants access to it and is trying to get into it at the same time.
The credit cycle is quite mature.
What we want to do is just be all things credit.
We do expect there to be some challenges ahead.
Private credit has been touted as this amazing thing, almost like NFTs or, ChatGPT.
I don't think that the boom in private credit all of a sudden suggests that private credit is bad asset class.
I think it would be impossible for us to ignore private markets and not think that there's a large opportunity set.
We don't think the very record tights that we have on credit spreads are reflective of some of the real challenges we have in the economic backdrop.
I look at it like this amazing force that will have hiccups in the years to come.
Those were some of the voices from our Bloomberg Invest conference earlier this week. So let's stay in the private market. Private equity can now kiss the era of easy profits goodbye. And this is according to Goldman Sachs. Now, Mark Nachman is head of the firm's money management arm, and he says where your returns come from will be much more focused on creating better earnings growth. And to do that, Goldman's bringing in some corporate muscle. Bloomberg's Sridhar Natarajan has been reporting on this story, and he joins us now. Corporate muscle, huh? What is that? Who?
Well, for one, they're bringing in the former chief executive officer of Honeywell, Darius Adamczyk. The reason it's interesting, especially at a place like Goldman Sachs, where you're used to them scooping up high-profile advisors, but even there, when you have the former CEO of a sprawling industrial conglomerate come in, that tells you what they're focused on. And what they say they're focused on is this new reckoning for private equity. Gone are the days when you can just bid at the auction, buy a company, sit back, watch the gains roll in and sell at a higher multiple. That's not likely to happen in this new normal of higher rates. That's what everyone's worried about. Debt is not cheap anymore, so you can kiss goodbye to cheap financing. Multiples expansion is not happening the way you used to, so there is a lid on valuations, there's crimp deal making, and if private equity funds cannot offload their portfolio companies, then how do you continue the cycle? Because this industry relies on funds buying companies, watching their value go up, selling those companies at a gain, returning the capital to investors, and those investors pouring that money back into new funds. Anything in that process breaks down, then it causes nervousness across the system. A lot of the people in this industry were at this fancy conference in Germany very recently where they had rappers like Fatboy Slim performing. But the real concern behind the scenes is what happens when the music stops. And that's what they're contending with right now.
Is Fatboy Slim's a rapper?
That's what I was told.
Oh, okay. That's news to me and then news to most rappers out there. It must have been a fancy conference, though, if he got invited. I am curious, though, about this idea of sort of what an Adamczyk hire really means, because you talk about the breakdown of that typical private equity process here. Is this about fixing up these companies in a way so that they can exit, or is this kind of a sign that they're going to be holding on this stuff for a lot longer, so they need to make sure that there's some cash generation in the interim?
There's some interesting statistics floating around, and there's been some research done over the last, let's say roughly 2 decades.
Yeah.
How have returns been generated at private equity firms? Like when they make their investments and then exit them, where are the returns coming from?
Yeah.
A fraction of it, it's less than 10%, has been driven by profit growth at these companies. A lot of it has been driven by leverage and other financial hijinks. If that component is disappearing and you still hope to be part of a process where you're buying a company and look to sell it at a higher value, then you're going back to the very basics. In some ways, that was the stated ideal of this industry when it started off 40, 50 years ago when it really took off, was we will find companies that require fixing, which have been underinvested, where management hasn't been great. We are the experts, we'll come in and fix it.
But
it's saying, let's do that again.
Okay, right, but you just can't do that by just like firing a bunch of people, cutting costs, and then hoping for the best.
You also want the company to last beyond day after tomorrow. So that's not always the simplest solution.
So this bodes very poorly for the private equity world, right? I mean, doesn't that make it seem like we're setting us up for real issues?
Yes and no.
Okay.
Because those who are the practitioners, the top end of this field will tell you, in the last 15 years, the problem was anyone could hang up a shingle saying, I'm a private equity firm, build up war chests, and see higher returns going forward. Now they're saying there will be dispersion because returns in the next 10 years will not look like the last 10 years. And dispersion usually means that those people who are confident in what they do and they think they have a good offering and a good product, they'll say, we'll actually stand out. Because in some ways you might say, why are senior executives at Goldman Sachs and Apollo talking about the challenge facing the industry right now? That doesn't seem like the greatest pitch. What they're actually doing is sharpening their pitch to these so-called limited partners, their investors, and telling them, look, there is a challenge. Some of us will be able to navigate this better than others because this is what we're doing. And that's why you need to suss out who are the good actors out there and who are not. And to be fair, LPs have been doing this work. They have been analyzing deals over the last 10, 15 years and seeing where that earnings growth, where that returns have been driven by. Has it truly been just financial engineering and multiples expansion? Or have they actually done good stuff with the company? The people who've been able to do good with the company stand to benefit in a more difficult and a more challenged environment.
All right, Sri. Great reporting, as always. Sridhar Natarajan here at Bloomberg News. Of course, a talk about a new hire over at Goldman Sachs to kind of help some of those private capital efforts. And I guess the idea that he's not really cut from the cloth of finance, but more from the cloth of operations says a lot about where they're at.
I know. Also, I thought he was retiring, but apparently he's too young to retire. He's got to do other stuff. He's not allowed to retire yet.
Yeah.
Isn't he like 54 or something?
Yeah, absolutely. So, it'll be interesting to see whether this actually comes to fruition, but more importantly, I guess, the idea of whether we see other companies sort of pick up the same mantle as well. When we come back, we're going to take a look at some of the big movers on the day, and one of the biggest, at least to the downside, is Walgreens, one of the worst days as a public company, as the company is in search of the right prescription to ease headwinds from a challenging retail environment. We're going to get a view from the sell side in our top calls. That's coming up next. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, the big movers on the back of analyst recommendations. And we're going to start off today with Viking Therapeutics. Morgan Stanley kicking off analyst coverage of the biotech company, an overweight and a 105 price target. Early data right now for Viking's weight loss pill and its experimental treatment for liver disease. That's going to give Viking a sharp edge in those markets. That's according to the analyst investors, bidding the stock up by about 6.6%. Next up, shares are carrying Gucci on the day, at least, on the heels of a double upgrade to buy over at Bank of America. The analyst there, Ashley Wallish, seeing signs of brand heat at carrying's Gucci label, which will eventually convert into stronger sales. Right now, looking at the foreign shares, they're up about 4%. Similar moves in its ADRs here in the U.S. And finally, U.S. Bancorp getting a cut to neutral today over at J.P. Morgan, as yesterday's Fed stress test highlighted the banks having among the highest loss rates for credit cards within the analyst coverage. The analyst expects a sharp increase in capital requirements, adding yet another headwind for the lender. U.S. Bancorp shares off the lows of the day, but still down by about 0.1%. And those are some of our top calls. All right, let's turn now to one of the biggest laggards of the day, and that is Walgreens Boots Alliance. Shares falling to the lowest point since at least 1997 after a disappointing third quarter report and a reduced profit outlook for the full year. The CEO hoping that cutting costs through store closures can be a step in the right direction. Stephanie Davis joining us right now. She's a senior research analyst over at Barclays. She's got an underweight rating right now on the shares. And Stephanie, I want to start off with some comments that the CEO, Tim Wentworth, made on the call about the consumer. The idea here that consumers are being a lot more selective, they're a lot more price sensitive, and a lot of the things that Walgreens has in their aisles, things that aren't in the pharmacy aisle, they're basically not buying anymore. Is there a solution to that?
I've tended to view that retail pharmacies may be a structurally damaged business model. And I'm not entirely sure this is something that store closures will be able to solve for. If you look at where the consumer is purchasing things, a lot of time online is the most convenient source, right? I think Amazon.com and even Walmart's online has been a good way for consumers to access their products they normally bought in the pharmacy. And it's also a more expensive venue for buying a lot of these items than something like an Amazon more often than not.
Well, it raises a question, though. I mean, if they are going to pivot a little bit harder into the pharmacy and healthcare side of this business, in theory, as a way to not only retain customers, but to get them physically in the store, we'd be remiss in not pointing out Amazon's moving into this space with its own pharmacy products, its purchase of One Medical. Walmart, of course, also has its own thing here. Do you have confidence here? And I know Tim is sort of new in the job, maybe about a year or so as CEO, but do you have confidence that management can maybe pull this off?
Look, if anyone is able to pull it off within my management's teams, Tim is as good as you get within healthcare management. At the same time, it is maybe an impossible task. I think part of the issue, you have this competition on the front of the online players. You also have CVS potentially being an irrational player. CVS wants you to have a positive experience in their pharmacy, not because they're looking to turn a profit, but if you have good thoughts about them and then you have maybe more compliance with what they ask you to do as CVS Aetna, they benefit more. So they're kind of coming at it from both fronts.
I hear you on that, Stephanie, but, still down almost 25%. That's a lot. I mean, is this an overreaction, do you think, or justified?
It's a lot, right? Whenever you have large-scale store closures, I think folks tend to go and have quite a strong reaction. It could be a bit of an overreaction today, but until they're able to go and turn around this arc, The question is, what is the underlying earnings for Walgreens? And it has been cut every quarter for the past few quarters. So I think folks are baking that more into the stock price reaction.
So then to your CVS comment, is it an easy like sell Walgreens, buy CVS, or is it going to be a sell Walgreens and then buy something else in this space? I know you were talking about Amazon, but other people in the space.
Look, if I had to make a bet between the two, I would say my preference is always going to be for a CVS over a Walgreens. I think CVS has some near-term headwinds as well in their payer business, but they are much more likely and much more able to turn that around than something like a Walgreens is. And I think Walgreens, yes, it's cheap. You know, turnarounds do not come without their hiccups, and that often takes time and proof points. And unfortunately, something out of their control, which is macro.
The macro. Well, let's talk a little bit about the macro. This came up a lot on the call. A lot of the analysts raised this point here. When we talk about how a company like this insulates themselves, I was always under the impression that the healthcare side of this business would provide a little bit more of a balance if we are seeing economic softness here. Is it too late for Walgreens to sort of, I guess, beef that up if indeed you do believe that we are maybe at the end of this economic cycle?
Well, the problem is that as much as back of house, more of the pharmacy side could be doing well, front of house has a lot of structural challenges. And shrink especially, just theft in the stores, that is a direct bottom line hit. And they're seeing a lot of that. There's no sign of that easing given how much pressure we're seeing on the consumer. They do have an opportunity in turning around their U.S. healthcare business. And I think their new executive, Mary Langowski, has done an excellent job of that so far. But that's an uphill battle, and it's not the majority of their business.
Hey, Stephanie, really appreciate it. Thank you so much for joining us.
Thank
Stephanie
you for
Davis
having me.
Over at Barclays joining us on Walgreens. What I find confusing is getting a macro read remain from all the different guys we got. So General Mills, that was suffering, but McCormick doing really well. Walgreens not. Carnival doing well. Like, what is my read through?
Well, I think the read through is exactly what we've been talking about, that this is not sort of a one economy, if you will. This is kind of a layered economy, and you have parts of it that are doing okay. Some are doing great, and you have a lot of parts of this economy that aren't doing well here. You know, I mean, it's funny. I looked at the McCormick thing, and we used to always joke that McCormick was recession-proof, right? Because everyone always, you know, you always buy spices, right? Even if you're poor, you still want to.
You have to have spices.
I mean, I do. I don't know. I mean, some people. I mean, are you like just a salt and pepper person?
No. I have a whole drawer that you pull out of spices.
Oh, okay. Oh, I misread you on that one.
Why would you not think I like spices?
I don't know. I mean, stereotypes. But but for those of us who are doing, real cooking and stuff like that, it's like, if you're in an economic downturn, are you going to stop buying spices? I don't know. That's my economic theory, the spice indicator.
I also do real cooking. I'm just putting that out there. All right, coming up, we get a preview of key things to watch in tonight's presidential debate. Our guest, Tina Fordham, founder and political strategist at Fordham Global Insight. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. So are you having a watch party tonight?
Yeah, this is where I gather all of the people that I actually hate in life, and I say, let's actually watch, the two presidential candidates debate. This is going to be interesting. Every time these debates come up, I always say there's no way I'm going to watch, and then I always get sucked into watching it because, research. I don't know what to make of this one, though. I mean, this seems like such a wild card, right? Like, normally you head into these debates and you kind of know we're going to talk about these issues. And obviously, who knows what Trump's going to come in with. And then Biden will be forced to respond. They can't respond to each other because their mics are going to be cut off. There's no audience. I don't know what's going on, Alex.
Oh, I don't know what a win would be like for either team, I think is my question. I'll probably do the 30 minutes in the beginning, get the vibe, right?
Yeah.
See enough of it so I can talk about it tomorrow, and then that's it.
Yeah.
And I can't take it anymore.
Yeah.
So speaking of Presidents Joe Biden and Donald Trump are facing off in the first debate of the election cycle. Joining us for more of her perspective is Tina Fordham. She's founder and geopolitical strategist at Fordham Global Foresight. Tina's been 25 years experience advising senior leaders from prime ministers to three-star generals to boards to institutional investors and the UN about the implications of global developments. And one of the most important this year will be the U.S. presidential election. Tina, what's a win for both of these candidates tonight?
Well, I'm glad you asked that question, Alex. First of all, remain standing. This is of paramount importance.
Oh, boy.
Okay.
Yes.
That's a low bar, Tina.
Well, I mean, it has caused problems for presidential candidates before. Remember Hillary Clinton's fainting at the 9/11 memorial, and there were some clips of President Biden at the D-Day landing ceremonies here in Europe where he appeared to be stooping. So standing, sentient, right? It is a low bar. And also swipes. Those are my 3 S's. Swipes, meaning the swipes that they are going to take at each other. This is going to be more like a worldwide wrestling match than a genteel kind of earnest policy debate like the one that took place in 1960 between Nixon and John F. Kennedy.
So it's like a wrestling championship, but the goal is to stay standing. I guess that makes a little bit of sense.
It's an octogenarian contest.
Fair enough.
Let's keep that in mind.
But Tina, for those who are watching it, is anyone going to learn anything if they're undecided or independent?
Well, I actually think there's a tremendous amount riding on this. There is a kind of a pre-game atmosphere going on. I mean, I'm in London. I have to stay up until 1 a.m. If Romain invited me to his viewing party, I definitely would go because I am a little bit of a political junkie, as you might imagine. But with so many undecided voters, with so many registered independents, and with these 2 candidates being deeply unpopular, right, the double haters, plus the global stakes and the domestic stakes, there is a lot riding on this. This debate is like the opening salvo, finally, in this campaign.
I am curious, too. I mean, it's interesting you talk about the undecideds here, and I guess the folks who can really sway this election. One thing that we are anticipating that could happen potentially today is that Donald Trump, the former president, will announce who his running mate is going to be. Now, we don't know who it's going to be. We know it's not going to be Mike Pence. But I am curious as to how much a VP candidate can sway undecided voters.
I mean, the answer is not very much. And historically, a VP candidate might be chosen if they could be, counted on to deliver a big state. The candidates that are being considered by Donald Trump, unless he does something, that would be very much on brand and surprises everyone. He said that his VP candidate will be there. There won't be an audience. Marco Rubio, J.D. Vance, neither of these fellows would deliver something that Trump couldn't get anyway, right? If he had gone for, somebody surprising, somebody who would add depth to the ticket, we'd be having a different conversation. But again, on historical norms, debates don't usually matter much, but I think this one will. VP candidates typically don't matter very much, and I think that's going to be the case here again.
So our Bloomberg reporting has kind of laid out what they think each candidate is going to talk about. Trump apparently going to try to hit Biden over the head with some of the issues involving immigration, as well as with Hunter Biden. And of course, Biden trying to make a plea for, I guess, the future of democracy as he sees it. I want to expand on that point just a little bit, Tina, because we've had several elections around the globe that ostensibly have been about much broader issues, whether over there in India and now what we're going to see in a couple of weeks in the UK and, of course, this weekend in France. I'm wondering if you could talk a little bit about what's going on over there in the UK and in Europe with the elections there, where while the issues aren't exactly the same in the US, there is a lot of overlap in sentiment.
Sure. Well, immigration has moved to the center as a mainstream issue, whether we're talking about the United States or anywhere in Europe. And that's not surprising given that numbers of immigrants have increased so much in the last several years. And that's driven by conflict and climate change and all kinds of things. But it's become a major challenge for governments because it's hard to stop. For the UK, where I'm based, immigration is something that the incumbent Prime Minister Rishi Sunak has spoken a lot about. He's not been able to turn back the small boats, as they are known. But it's actually not listed in the sort of top 5 policy priorities for British voters. That's not the case in France, where Emmanuel Macron's snap election is seeing immigration come to the fore, as well as this kind of, very theatrical consolidation of the hard left, historically quite Marxist in France, and a pretty, Eurosceptic, anti-immigrant, culture war-oriented, to use the U.S. terminology, far right, which is likely to do quite well in these legislative elections.
Tino, what happens to the bond market over in France on Monday and then the following Monday?
Well, so this is something we're looking at very closely. It's the first time we've seen a return to European political risk, really since 2012 and since Mario Draghi uttered those famous words, whatever it takes. Let's remember, though, that since then, the ECB has put in place a lot of mechanisms to absorb the shock. So our view is that any volatility that takes place will probably hit French financials hardest. Not really certain yet whether there'll be a spillover to other European names, but that second round is of crucial importance. So don't get spooked on Monday morning. There's a second round to go, and Macron is playing a long game, in my view. He needs to get through. He will get through to the second round, but the more he can force the far left and the far right to kind of compete against the other, it's a high-risk strategy. But he hopes that he'll be able to not only survive, but do okay. And he stays on as president. Very important.
All right, Tina, we have to leave it there. We have to get you back once we get through these next couple of elections in the UK and Europe and get your insights on the outcome there. Tina Fordham over at Fordham Global Foresight, the founder and geopolitical strategist over there in London. And be sure to tune in to our special coverage of the U.S., the first U.S. presidential debate of the cycle. That airs tonight at 9 p.m. Eastern time on CNN. And, of course, we'll have full coverage right here on Bloomberg Television as to how things shake out. All right, coming up here on the Big Pick program, we're going to take a look at, two stocks that seem to pop for seemingly no reason. Roaring Kitty, apparently a dog person now? I don't know. A cryptic tweak and a 30% jump in the shares of at least one stock there on Chewy. Petco was also up about 10%. Shares have peeled back just a little bit. It's our stocks of the hour, and they're coming up next. This is The Close on Bloomberg. All right, time now for our stocks, plural, of the hour. A closer look at Petco, a closer look at Chewy. Shares that had surged just a little while ago. You can see there on the screen, though, they have reversed almost all of those gains. This was, though, an interesting move that we saw in the middle of the day. Chewy at one point rallied more than 34% in the span of about 10 minutes on the back of a single tweet by Roaring Kitty, a post on X of a cartoon picture of a dog. Abigail Doolittle is joining us right now to help us sort out what this dog means. Abigail, let's first start off with the market moves, because, this was phenomenal. Really, when you talk about the lows of the day that we had on both of these stocks, this was really like a 40% move on Chewy. You had something like a 12 to 15% move on Petco, all based on this. And, of course, the stocks sold off almost as quickly as they rose here. What's going on?
It's really unbelievable to me that you can have a stock go up 30% on a closing basis if it had closed at the highs, or 40% on an intraday basis, all based on a meme of a cartoon dog. It's sort of ridiculous. If anything, I feel
would have been better if it had been a real dog instead of a cartoon.
Well, you know, that might have given a little more weight. But I think that if anything, this is really a message to the Fed. There's so much liquidity in the system that this
message to the Fed.
I really do, because there's just no fear here. There's so much excess liquidity that it's able to find a home very quickly like this in a stock like Chewy, like Petco, but GameStop, because of course there's the Ryan Cohen connection between GameStop and Chewy. GameStop itself had a big spike earlier today ahead of these spikes. It spiked about 10% from the open toward the highs. It's now still up 3.2%. Petco down slightly. Chewy hanging on to a gain. The question is, will it close higher? I tend to think not. What goes up must come down. It's absurd.
But to your point about the liquidity part, like the GameStop, 2021 lasted a lot longer and ran a lot harder. The GameStop period this year, not as long. This was a day. Like I feel like
it was 15 minutes.
are not as long as they were before.
Well, I think a piece of it is back in 2021, there was this sense that it was the institutional traders versus the retail traders, and there was a moral sense that the retail trader could actually beat the institutional trader. Now I think that there's a moral sense, what's going on here? How can some traders with one single stock of a cartoon dog make a stock go up 30% in a day? And also with the GameStop situation with Roaring Kitties not so long ago, not knowing what sort of profits Keith Gill made on GameStop. I think there's more questions now as opposed to this camaraderie of let's take these old school stocks and make them rise.
And it was funny, we were talking with Mike Contopoulos earlier. He was talking about how conditions really aren't all that tight in terms of financial conditions, basically talking about the Fed and all that. Obviously, he wasn't talking about it in the context of Chewy and GameStop, but maybe that's indicative of it. The option activity, though, has been pretty elevated, and it remains elevated, even though the prices have come down. I mean, most of the activity we've had today in terms of volume has actually outpaced open interest pretty much across the board here. So I wonder if today is just a prelude to maybe what we see over the next couple of days.
I think that you were making a great point here, because relative to GameStop, I think his first tweet was in mid-April. It was just the picture of him sitting forward playing a game. Or somebody playing a game.
I saved that one.
So yeah, you did save that one. Yeah, I mean,
I'm going to try to find them and get them to sign it. These are going to be collector's items. It's going to be like a Banksy.
All right. Yeah. Abigail, thank you very much. Appreciate that. We're about 15 minutes from the closing bell. We're going to count you down with George Patterson of PGIM. This is Bloomberg.
Honestly, I think the markets and the real economy are pretty much in sync. I mean, you haven't seen a big collapse in yields because the data is pretty strong. You have seen sort of more speculative areas of the market recently run because liquidity is still easy. I think this idea that just because the Fed hiked, 500 plus basis points, that all of a sudden that magically means that they're restrictive and things should start to slow, maybe just suggests that the neutral rate is actually higher than what most expect. And so I think actually the markets and economic data are very much in sync right now.
Mike Contopoulos, Director of Fixed Income over at Richard Bernstein Advisors, speaking a little bit earlier to kick us off to the close. Alex, a day where we see yields move slightly lower here, down about 4 basis points on that 10-year. And stocks, which actually opened in the red, trying to hold on to some gains. I think at one point the S&P actually did trade above its record high, though.
For like a hot second.
I'm not sure it's going to meet that, depending on what happens in the next 9 minutes.
Yeah, but you got consumer discretionary outperforming. Thank you, Amazon, hitting a record high alongside Microsoft and Google. And also, Caesar is doing really well. It was nice gaming revenue in Las Vegas. No, gambling. They like the gambling.
Yeah.
And then you have consumer staples, though, getting hit in part because of Walgreens. So you have sort of the barbell there on the S&P. Like, S&P now flat on the day.
A lot of activity going on in the real estate and REIT stocks as well. Keep an eye on that, as well as the regional banks. Regional banks having one of their best days in a while. Let's keep it going here as we move closer to those closing bells with George Patterson, Chief Investment Officer over at PGIM Quantitative Solutions. And George, we came into this morning with a couple of interesting data points, weekly jobless claims. We got a monthly numbers on pending home sales, an update on GDP, as well as a look at business inventories. And when you put them all together, it seemed to suggest some softness in economic conditions. When you guys are out there modeling where we are in this economic cycle, did the data today reflect your general outlook, or is that kind of an anomaly?
The data today were very mixed, and there was really no surprise. Some numbers were a little bit better than expected, some numbers a little bit worse, but it's still very consistent with the story that the Fed is being effective, and the rate hikes have been slowing the economy. We've seen that. We've seen evidence of that. No sign of an imminent recession or hard landing. I think we're still thinking the most likely scenario is a soft landing. Timing, of course, is uncertain.
What's like when you talk about strategies for a market like this here? Are there longer term strategies that you feel comfortable with, or are most of the trades right now, at least the ones you find potentially more profitable, they're going to be much more tactical in nature?
At PGIM Quantitative Solutions, we're always focused on the longer term. It's just that's the best way that we find to add value for our clients, and it's for most of what our institutional clients are looking for. So we always think longer term. There's no standard rule book for how you're going to invest in a market like this. What is just amazing is that this mega or even ultra cap stocks have just run and really driven the market. And if anything, the last few months, the market's gotten even more narrow than it's been year to date. It broadened for a little while up through March, and then it's gotten even more narrow. There's just been a large swath of the market that's been left and is a great opportunity. It may take a little time to come through, but going beyond those top 5 or 7 names is there's a lot of value out there.
So yeah, just to your point, there was a great piece on the Bloomberg terminal that talked about the tech weighting in the S&P is closing in on 35%. Like that's like .com era situation. So do you avoid those guys, or do you kind of just sit in it and relax and then like buy stuff that you think is really undervalued? And how do you screen?
So we do a number of different things. We are active in the tech stocks because at the end of the day, they are growing, and there's good earnings.
Can't live without them.
and I think it makes sense that so much of the S&P has a tech weighting because this is a different world. It's not the 1970s or 80s. If you go back and look at the 70s, energy was probably at 30%. It's a different environment now. So I think the weighting of tech makes sense. It's not a reason for concern. We own those names, but we also try to find areas where there's opportunities outside of really, it's smaller cap. It's names where people have been assuming that we're going to end up we're going to have a recession or a hard landing, and they're focused on high quality, growthy names. But pretty much everything outside of those names has really been ignored. Small cap in general, I think they've seen some stories about how it's just a recent dispersion between S&P and Russell 2000.
You guys have also shown a little bit more interest in emerging markets too, which is a bit of a contrarian call. I mean, a lot of folks are still kind of spooked by what happened, or more or less what didn't happen over there at the start of this year here. What gives you any confidence to move there?
So emerging markets are interesting, and what's really interesting is that it's not one market. There's many different markets. Our clients, institutional investors, are most interested in getting exposure largely ex-China. And at the end of the day, if you think about the future of GDP, you think about population growth, which drives GDP growth, that's going to occur largely in emerging markets. So there are a number of markets that are set up for long-term outperformance, markets like India, Brazil, Korea, Taiwan, number of markets where different drivers in each of them, but the long-term opportunity is very large.
Do you invest around those elections? I mean, you mentioned India, Brazil. We just had an election in Mexico, and of course, we have two big ones coming up in Europe, and of course, the granddaddy of them all in November here in the U.S.
Elections are an interesting challenge for quantitative investors. We will opportunistically take risk off if we feel that there is enough uncertainty. Not so much about which particular party is going to win, but about the policies of the party. So when there's a big bifurcation in the policies and things could change drastically, that may be a time that we take risk off the table, reallocate into other strategies, and then potentially re-risk coming out of an election.
So put this all together for us. Do you care what the Fed does?
Yes, of course.
But the point is, like, your thesis stands even with rates at this level, right? And with the economic data that we do see. So how, like, does 25 basis point cut really affect this thesis you have?
There are 25 basis. We're not thinking about a 25 basis point cut. What you find is that when they start cutting, they're going to be cutting for a period of time. They're not going to cut and then wait at that level for a long period of time. They're going to cut, and then there'll be another cut. The same way they raised rates. So it's really it's the signaling of the central bank, the direction that they're taking. And I think the central bank wants to cut, or I think at least Jerome Powell wants to cut rates. He sees that they're being very effective at slowing the economy, and they're trying to land the ship as smoothly as possible.
All right, George, always great talking to you. Always great insights here. George Patterson, he's the CIO over at PGIM Quantitative Solutions, helping us count you down to those closing bells. Alex, just about 3 minutes to go here. Stock's pretty much where they've been now so basically since we started the show, more or less here. But we are seeing a creep up in some of those names that he was talking about in that small and mid-cap space today.
Yeah, you have to wonder tomorrow, is it going to be exciting when we have eco data and the end of the second quarter and the first half? Like, are we going to see some liquidity come into the market?
I'm actually really intrigued by this. You're referring to the PCE report tomorrow?
I am.
And I am kind of intrigued to see what it says and whether the market is going to care. I mean, if it's incremental, do they just shrug it off? I don't know. What's the reaction?
I mean, I'm actually a little bit more interested in the personal spending and income part.
Yeah, absolutely.
Does that actually hold in?
Yeah, and that's exactly what Bloomberg Economics has been focused on as well, and they're seeing some softness there. I thought Stuart Ball had a great note out this morning really talking about some of his concerns there. As we move closer to these closing bells, stick with us. Our full market coverage starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Alex Steele to take you through the closing bell. It's our global simulcast now. Scarlett Fu in the TV studio, Carol Massar and Tim Stenevik in the radio booth as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube as we parse the most crucial moments of the day. A lower open for stocks, but it looks like, Carol, if this holds, we'll have a higher close for most of the major indices.
Yeah, just barely, right? You look at the S&P 500, kind of an even split here, but little gains overall. Right now, we just had the S&P dip into the red. So, really just trying to eke out a gain, but it looks like it'll be a flat market for the most part.
We spent a lot of our program talking about the implications of what happens tonight when it comes to the economy and when it comes to the markets.
What's happening tonight?
Well, at 9 o'clock, the CNN presidential debate takes place between President Biden, former President Trump. I do expect quite a bit to come up about the economy, especially when it comes to inflation. Obviously, markets will not be open during that time, but we'll maybe we'll hear more about policies from either president.
Policies?
Yeah, okay. Economic policies.
Or maybe we'll wait until we get core PCE at 8:30 a.m. on Friday to answer some questions.
But we all know what that's going to look like. We've been, have our pencils out doing our calculations, right?
Yeah, but don't we also know what the debate's going to be like? Come on now. It's just going to be the show. But what I do think is interesting, guys, tomorrow in the second quarter, first half of the year, sell the winners, buy the losers. I don't know. I think there could be some liquidity that comes in tomorrow. That could be exciting.
We've seen that rebalancing going on right now over the past week as a lot of people, have some big winners that they have to sell, maybe take some profits off the table. The question is, where do those profits go? Do they pile back into equities and continue this rally, or do they go somewhere else? Screen across the screen here on this Thursday afternoon. Modest gains to be sure, but I think some investors will take it. The Dow Jones Industrial Average right now up about 0.1% as we wait for these numbers to settle. The S&P 500 up by about a similar amount. We should point out at one point in the day, in the intraday, it did trade above its record high. It is going to close below that, though, on this day. The NASDAQ Composite up about 53 points or 0.3%, while the Russell 2000, that's your outperformer on the day, guys, up 20 points or 1% even.
All right, to the S&P 500, we'll continue there. 284 names to the upside, actually gaining some ground today, Scarlett. 217 to the downside, 2 unchanged.
All right, let's take a look at the IMAP, which shows us how the different sectors are performing, and a pretty mixed showing here. REITs have now climbed to the top, gaining 0.9%. Consumer discretionary, also a big gainer, and that's really on the back of Caesar. And communication services up about 0.75%. On the flip side, you've got consumer staples, and that's dragged down by Walgreens, healthcare. Another decliner, although it's pared some of its losses because of CVS. Interesting that CVS and Walgreens are in different sectors. Materials and financials also lower.
All right, let's get to some of the individual gainers. So here's some outperformance, folks. Maybe investors giving up a little bit on the chip sector here, but if you look at something like a Salesforce or Palo Alto Networks, really some outperformance. Salesforce up almost 4% in today's session. You see this among the top gainers in some of the major equity averages. Move on to Palo Alto Networks. Also a gainer, up about 5%. So just some sector rotation going on here. Not necessarily any specific news on these names, but nonetheless, really some outperformance there. BlackBerry, how about a blast from the past there? This one up at its highs, almost 17% in today's session, finishing the day with about 11% gain. Yes, it's a $2 a share stock. About
Is
a
that Canadian or U.S.?
U.S. Oh, Canadian dollars? I don't,
Wow.
All right.
I thought you knew that by now, Carol.
Rude, Romaine.
It's a $1.5 billion stock. I'm assuming that's in U.S. dollars.
It's in dollars. It's in U.S. dollars.
It's in U.S. dollars. Thank you very much. Rallying after the company reported first quarter revenue that came in ahead of estimates. CIBC upgraded the recommendation on the stock, noting that the better than forecast print and conservative but achievable second quarter and full year guidance. So they like that. Should point out Raymond James and TD Cowen, lowering their price targets on the stock. And once again, just reminding everybody that is U.S. dollars. McCormick, something completely different. This was a top gainer in the S&P 500, up about 4% today. Spice Maker, of course, reported second quarter adjusted EPS exceeded the average analyst estimate. Company's net sales also came in roughly in line with Wall Street expectations. All right, so some really big outperformers there.
Okay, you got the outperformers, I got the underperformers. I do want to start with shares of Micron Technology dropping after the forecast disappointed investors investors who were looking for a bigger payoff from AI mania, down 7% today. Fiscal fourth quarter sales will be $7.4 billion to $7.8 billion. The average analyst estimate was actually $7.58 billion. Some projections were above $8 billion, so it showed how investors had really high expectations for those numbers that came after the bell yesterday. We did see also shares higher by about 60% going into the print yesterday. So again, investors had high expectations. We did see profit come in at $1.08 per share versus a projection of $1.02. Walgreens Boots Alliance. Biggest decline today, going all the way back to 1980. Shares falling by more than 22%. It's actually now trading at levels last seen in 1998. The company slashed its guidance due to a worsening retail environment. It announced it would close significantly more stores. Its new CEO is looking to turn the business around. In addition to shuttering locations, management said it would make more organizational changes without specifying if there would be further job cuts. The company has had a rocky few years with turnover in the executive ranks. It's been a challenging retail climate for the company. Shares falling by more than 22%. Also on the decline today, Levi's shares at one point falling the most ever, though closing at their worst since 2023, falling 15.4%. The company did report quarterly sales that fell just short of estimates. Again, high expectations. Shares were about 40% higher through yesterday's close before these numbers came out. So investors certainly had high expectations. Revenue coming in at $1.44 billion in the fiscal second quarter versus the average analyst estimate of $1.45 billion. So just an ever so slight miss there. Sales in the Americas were strong, fell short in Europe and Asia, Alex.
Yep, and also denim's like having that big moment, so that those expectations were high. Let's go to the bond market for a second, guys. We saw a pretty strong bid, yields lower. The big news, though, was we got through a ton of supply this week. The 7-year actually went pretty well today, and then headed into tomorrow with the PCE, personal income and spending. I should point out that the BlackRock iShares long bond ETF had almost $3 billion in inflows on Monday. So you have to wonder what the positioning is like headed into the numbers tomorrow, plus the end of the quarter.
All right, guys, you know how we like to kind of get a good read on consumer sentiment. Sometimes it's like whether or not people are spending money to go to the movies. Well, having said that, it could also just be a sign of whether or not something is kind of good. And that brings us to a most-read story on the Bloomberg terminal. Kevin Costner's, his $100 million Western headed for the box office. And apparently, right now, the estimates are that maybe it might bring 12 to 20 million in over the weekend.
Did he learn nothing from Waterworld?
That's a good point. But before Waterworld,
Dances with Wolves.
Yeah, Dances with Wolves did more than $400 million in revenue. It was a $22 million production. Right. So, and he's been working on this since 1988, Alex. He actually put $38 million of his own money into the movie. So if he doesn't get sales up, could be hard to recoup the investment.
I'm actually intrigued that he took this on his own, and it really kind of shows you just how the economics of Hollywood are kind of lopsided here. But I mean, look, if you like westerns or you like Kevin Costner, I guess I don't know. I haven't seen the reviews on this thing, but
50% score on Rotten Tomatoes. Yeah, exactly.
Not good.
Not good.
50.
Not good.
Yeah. Well, also having the words Chapter 1 in the title is not encouraging.
Also, literally, didn't he make this movie? I understand Dances with Wolves had a different premise, but he made the movie, right? That already happened. I don't need to see another one with Kevin Costner.
He really likes this genre.
He likes, right? Yellowstone, right? That was so popular. He's not coming back for the last season, but it's really kind of interesting. So we'll see. Something to see over the weekend. What do you guys got?
Okay, so we're looking at Fisker. So this is really interesting also. So you could buy a Fisker car, right, for about $70,000 in EV. Now, that company has since gone bankrupt, and that's creating a lot of problems for some of the buyers. For example, you can trade it in. One guy traded his $70,000 almost new car in for $23,000. If you want to get your car serviced, it's really hard to get somebody on the phone because you don't go to a traditional dealership. And because they're in bankruptcy, they let a lot of people go. That's rough.
After sales service is always the problem, right?
Yeah. Yes. And it's not just Fisker. You saw the same thing with Polestar, and you've seen, even with Tesla, you've had some of these complaints here. But it raises the question, at least for those companies that aren't well established, like a Tesla or a legacy automaker, if you're buying one of these cars, you really are kind of taking a gamble that they're going to actually be around in 2 or 3 years when you really need them.
Yeah, I talked about this actually with a friend on Saturday who I saw over the weekend. He has a Rivian, and I asked him his thoughts on it. He said he loves it, but he's a little concerned that it might become a brick one day if the company doesn't survive. That was before the $5 billion infusion from VW, but it's certainly something that's on the mind of folks who have EVs from startups, no question.
Yeah, it's a really good point. All right, guys, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals, we call it the closing bell. We'll see you again, same time, same place tomorrow.
All right, stick with us here on Bloomberg Television. A lot more coming up on the close. We are awaiting more earnings, this time out of Nike. Instant and full analysis right here on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Let's take a look at how markets closed out here on this day. We started out lower once again, but markets, as we've seen in the last few days and weeks, started to get pretty strong bids in that final hour of trading. Enough to get everything above the waterline. Not much of a return here on the day, but some people will take it. 0.1% on the S&P 500. Similar move on the Dow Jones Industrial Average. 0.3% on the NASDAQ. But there were some cracks going on in the market today. You saw that in the Bloomberg Healthcare Index, a big drag from Walgreens. Boots Alliance, Scarlett, here on this day. Some concerns about the health of the consumer. In fact, the CEO had some interesting comments here about the price sensitivity that he's seen with his consumers.
Absolutely. Walgreens Boots Alliance slashing its full year guidance, citing a worsening retail environment. And on top of that, the company says it's going to be closing significantly more stores as part of its ongoing turnaround effort. The stock losing about a fifth of its value, the biggest one-day drop since going back to all the way in 1980. Now, Levi's down about 15% on the day. No beat and raise quarter here for the company. The sales slightly missed estimates, and the denim maker left its full-year guidance unchanged. Investors were definitely looking for more, given how popular denim has become as a category unto itself, and the fact that it had fairly easy comps the previous year. Now, one more. International Paper losing about 7% after Brazil's Suzano dropped its effort to acquire IP. Suzano said it was never able to draw the company into serious engagement and was unwilling to increase its offer. Now, this move allows International Paper to move forward with its own M&A plans with rival DS Smith. But our top story this hour is Nike. For Nike, it's time to just do it. Investors have been waiting for evidence its turnaround is gaining traction. The athletic gear maker is cutting costs as part of a 3-year, $2 billion efficiency plan and has warned that sales will fall in the first half of this fiscal year. Nike's strategy to sell more of its products through its own retail stores and website kind of backfired, giving old and new rivals alike some room to steal consumers' attention. The focus now is whether its newest products can refresh the brand and drive a wholesale restocking cycle. Romaine?
All right. Well, before we get to Nike, we are awaiting those earnings. We want to talk a little bit about the broader market, and who better to do that with than Bruce Bond, a pioneer in the ETF industry and now the co-founder and CEO of the Innovator ETFs. Bruce weighing in on the current market just recently, writing that investors need to be in the market and the interest in buffer ETFs, specifically with 100% protection, is exploding. Bruce joining us right now on a day, Bruce, where we saw both the NASDAQ and the S&P get closer back to those record highs. And that's a big part of the reason why a lot of people are looking at the end of this quarter and looking to the second half and saying, how do I protect my gains? Talk to us about this buffer ETF and exactly what kind of protection that would provide.
Yeah, thank you very much, guys, for having me. Yeah, you know, with the S&P 500 up 25% over the last year and the NASDAQ 100 up about 32%, a lot of people are really asking themselves, what do I do today? And, you know, we got $6 trillion on the sideline, and these people think they've done well, but they've really missed out on most of the market. Well, I have good news for them. We have a product that they're going to be able to participate in that will give them 100% protection on the downside. They come on July 1st, and they give you a certain amount of the upside. If you're not familiar with defined outcome ETFs and the buffer ETFs, go to Innovator ETFs and find out more about it. Yeah. One is 6 months. And so if you're nervous about the election or the recession or that, you know, you could do the 6-month product. It'll give you about 5% on the upside. And then there's a 1-year product that will give you about 10% on the upside. And then there's a 2-year product, give you about 18% on the upside. And so you get to participate in the upside of the market, but you have no risk on the downside.
Well, I am curious, though, too, for those folks seeking protection, a big part, let's talk about why we're even talking about this, Bruce. As you know, there are a lot of people that are looking at economic conditions. Even though they may seem healthy now, there's this concern that we are at the end of this economic cycle, or at least getting closer to it here. I'm just curious that when you're sort of taking this broad view of where we are in the economy here, do you get the sense here that maybe that there is trouble going on out there?
Well, I think that's the concern, right? You guys just mentioned we're basically at all-time highs in the major indices. And people have missed out. You know, there's a lot of FOMO out there. They want to get in, but they're not sure what to do. And I think there's a good chance that we could see weakening ahead, and then they're going to start cutting these rates. So for all that money that's in money markets, it's going to start to underperform. And you could see the stock market pick up after that, and then they're not going to participate in the run-up if rates do start to come down. And so, yes, I think, it's questionable what the market's going to do going forward here, especially with the election, with the wars and rumors of wars and, all these things.
Yeah,
but
hey, Bruce.
That's why we think this product's kind of ideal for people.
Yeah. Hey, Bruce, hang on for 1 second here. I'm in conversation with Bruce Bond right now. Those Nike earnings we were telling you about, they are crossing the wire right now. For the fiscal fourth quarter, it looks like a miss pretty much across the board for all of the key metrics. Revenue was down about 1.7% in the quarter to $12.61 billion. That's lower than what the street was looking for at about $12.86 billion. EPS, though, did beat here. They come in at about 99 cents a share. And that's above where they were a year ago at 66 cents a share. Not sure of the analyst comparison there. But we should point out gross margin came in below estimates. Inventory numbers, though, came in a little bit better than what the street was looking for at about $7.52 billion. And Scarlett, those revenue numbers coming out of China, which a lot of people are focusing on, seen a little bit of a rebound there, $1.86 billion in revenue in the Greater China region, and that's slightly above what the street was looking for.
Yeah, Greater China once made up almost 1/5 of Nike's global sales, has now come down to less than 15%. So Nike is really banking on China, especially with its premium Jordan brand, to goose sales once again. Fourth quarter Greater China EBIT, however, did seem to miss analyst estimates, $548 million versus a consensus estimate of $552.6. But I guess one thing at a time, right? You got to get revenue up before you can get EBIT up.
Taking a look at some of the units here, it's kind of interesting when we talk about the footwear, which of course is probably their biggest business, $8 billion in revenue. That was down 3.6%. Converse revenue was down 18% here. Global brands overall down 21%. The two bright spots were in apparel revenue. That was up 2.8%. Then and equipment revenue, that was up 34%. But of course, equipment revenue, that's their smallest business, only making up about $600 million in sales.
Yeah, you wonder how much of this is tied up in its strategy to really focus on its own retail stores and its own website as opposed to using third-party distributors, because it really took Nike products off a lot of store shelves and gave its competitors room to signal to consumers, hey, we're here, we're new.
Yeah, absolutely. Here, the shares, which had actually popped higher as soon as the results come out, now flipping into the red. Abigail Doolittle standing by with us right now here in Studio 2 to help break down the numbers. Abigail, what's your initial take on this? I mean, overall, the numbers certainly below estimates, but not exactly awful, are they?
Not awful at all, especially given the fact that you have the earnings beat, 99 cents versus 66 cents. And as you were just mentioning, the stock was initially higher, so I was scouring among the misses what investors are looking for. You mentioned the slightly better inventory than expected, coming in at $7.52 billion versus $7.99. So they're working through some of it.
And I feel like that might be key, because that was the big concern. And I think Scarlett was kind of alluding to this the past quarters. I mean, they just weren't selling to the extent that they needed to sell.
And also what folks are really looking forward to is the product refresh, especially tied to the Paris Olympics. So they need to push some of the old stuff through the channel so that they can sell the old stuff, the new stuff. I mean, there is a possibility if people were just flocking toward the new products, they could discount the old items so much that would push it forward. But that revenue miss, investors not liking, and you highlighted, Romaine, that gross margin miss, 44.7% versus the estimate of 45.3%. Right now, the stock down 3.7% off of its lows, really all over the map. It looks like they're updating the full year. I think we're going to need more color out of the conference call, because everybody's saying the main thing is a competitive position against other products.
Forgive me if you mentioned this already, but I was looking at the direct revenue numbers. That's basically what they sell through the web. That was down 8%. on a reported basis in the most recent quarter. Now, I don't know if that's a deliberate strategy. I mean, wholesale revenue was up 5% in the quarter, so maybe that is deliberate. But remember, it was their own website, that direct-to-consumer.
Yeah.
That was kind of what made this stock so good for so many years, and I guess
before it stopped being so good.
Yeah,
that's a good point.
Yeah.
And I think that's something that we'll need to get more color on from the company. One thing I should mention is, of course, the CFO of Nike talking about driving better balance across our portfolio and taking actions to reposition Nike to be more competitive. And Abigail, that goes back to the idea that Nike is still very much knee-deep in its cost-cutting plan.
Knee-deep in the cost-cutting plan, and what they really need to do is go on the offense. That's defense. They need to go on the offense and deliver these new products. I mean, it's interesting to see because there's been a lot of chatter about the fact that their running shoes not competitive with the like of Hoka, On, and so on and so forth. But Converse, even, those revenues fell 18%. So the cost cutting can only do so much. In this case, it really didn't do that much relative to the margin, although you did have the EPS beat. But now they've got to drive that revenue. They've got to bring out these new products to wow analysts. From an option standpoint, it had been predicted that this stock would move up or down 5%. Right now, we're getting that to the downside.
All right, Abigail DeLittle, fantastic instant analysis on Nike. The stock moving down and after hours trading right now, lower by almost 5%. Let's bring back Bruce Bond, co-founder and CEO of Innovator ETFs. And Bruce, I know you were listening to us go over Nike's results. I want to get your take on the retail landscape right now. The recent retail sales figures really indicate that there's some softness in terms of demand, and consumers are definitely a lot more particular about their spending. How do you see that filtering through into the market at large? Because right now we continue to see the broader market continue to inch higher and make new highs or hold near new highs.
Yeah. Great question, Scarlett. I think that we're going to continue to see that. I think that, consumers generally are getting the pinch when it comes to all the other expenses that they have in their lives, and they're looking to reduce in areas they can reduce. And so I think it makes sense that Nike would start to feel some of that in here. And I think we're going to continue to see that as we go forward. And, that's really what everyone's hoping for, a soft slowdown. But I think we're going to have to see a decrease in rates here probably early next year. Which is going to, affect the equity markets, maybe get it to go up a little bit. But at the same time, I think a lot of the money that's just sitting on the sidelines, in money markets or short-term debt, is just going to not really keep up with the market, especially when you consider an after-tax return for people.
Yeah, very good points. I want to go back to overall the buffer funds and this idea that people are looking for protection to the downside and they want to produce income. There's a whole group of ETFs that have been created to meet that need. And Eric Balchunas, our Bloomberg Intelligence senior ETF analyst, calls it boomer candy. ETFs that use derivatives to produce extra income to protect against losses. What is the evidence, Bruce, that this approach works in periods of extreme stress and not just periods in which the stock market is placidly climbing?
Yeah, well, they work best in a stressed market, actually. If you look back, we started in 2018 with the first buffer ETFs, and we've come to today, and every one of them have delivered on the payoff that they promised to investors. And so even during times of, a lot of volatility in the market, steep downtrends, uptrends, they've done exactly what they've expected, or what we've expected and what investors would hope for. So they've been really tested. Yeah. And I think on a go-forward basis, people are getting comfortable with them. Now they're starting to weigh in. We're seeing more and more assets flow to the category. And if you think about it, 72% of the investable assets are in pre-retirement or, baby boomers' hands. And they are looking for a way to invest their money, but not take the full risk of the equity market. Well, how do you do that today? This is an excellent way to do that.
All right, Bruce, we're going to have to leave it there. Apologies for the interruption in today's conversation. Got to get you back for a longer conversation. Bruce Bond, co-founder and CEO of Innovator ETFs. Some breaking news just crossing the wire. This on the NFL. If you got direct TV Sunday ticket here, you might be in for a repayment. That antitrust trial that was taking place in Los Angeles has concluded with a jury finding that the NFL and the teams violated antitrust laws in that Sunday ticket broadcast package here. We're now learning that the NFL must pay about $4.7 billion in damages for what the jury has determined was a TV broadcast monopoly. We're going to get you some more details on that, but a 9-year saga coming to an end today, $5 billion in damages right now facing the NFL. This is Bloomberg. The recent breaking news just coming out, a jury in Los Angeles finding that the National Football League here in the U.S. violated antitrust laws and must pay damages of about $4.7 billion. Now, Scarlett, this all involves questions about whether they had a broadcast monopoly with this Sunday DirecTV package that effectively meant that there were just certain games that you were only going to be able to see if you got this package. And fans basically said that was a monopoly. They've been fighting this in court.
Yeah, football fans sued 9 years ago, saying that the NFL teams and, of course, the NFL overall and DirecTV conspired together. Now, DirecTV no longer even holds this package.
Yeah,
right?
YouTube does.
YouTube does.
Yeah.
So this just goes pretty far back. But this is definitely a defeat for the NFL. We'll see how they respond.
Yeah, definitely a big story. And we're going to focus a bit more over the next 30 minutes on sports, including a look back in history and one of the biggest TV deals for the NBA. This is Bloomberg. All right, with the NBA draft set to wrap up today, the league is set to turn its attention to its media contract negotiations. So it's worth a look back on this day in history in 2007 when then Commissioner David Stern inked an intriguing 8-year TV contract extension with ABC, ESPN, and Turner Sports. It was a $7.4 billion deal, roughly 20% higher than the previous agreement. But more important, it was the first contract to include extensive rights for the networks to broadcast games on the web and mobile phones. Now, the NBA had no choice but to offer up those digital rights. It was at a time when ratings for traditional TV broadcasts were hitting all-time lows. Offering the digital rights was a big lifeline for the NBA and for the networks. That meant that they can now create interactive online elements, such as selected camera angles, statistics feeds, and a video to complement those telecasts. It was a natural evolution of the NBA's media strategy, one that dates all the way back to 1953, when it signed a contract with the now defunct television network called Dumont. Several deals followed with NBC, ABC, CBS, but it was really 1979 when the current shape of NBA media contracts began to appear. That was the year the NBA embraced cable television. It was then a paltry 3-year, $1.5 million deal with the USA Network. Turner Sports will replace USA as a primary national cable partner by 1984, and that's a relationship that the NBA has more or less maintained ever since. Now, after that 2007 contract deal, the league in 2014 announced a 9-year, $24 billion extension with Turner, ABC, and ESPN. That was then the second most expensive media rights deal in the world, and it put the NBA's media revenue on par with the Premier League. Now, the size and scope of sports media rights continues to grow. S&P Global is now estimating that the worldwide value may break the $60 billion mark by next year, led by international football, with American NFL football ranking second. Now, it's now said that the NBA is well into its negotiations for the renewal of its media rights that could include adding 2 new partners, Comcast and Amazon. Bloomberg News reported last month that the new deals combined could generate $76 billion for the league over 11 years, making it the third most lucrative media rights deal out there in the world.
It's a far, far cry from that $1.5 million contract that you were just telling us about. Just stunning, the numbers and the growth there. And of course, Nike played a key role in all of that with its Air Jordans on number 23. So let's get to those latest results from Nike. The company reported quarterly sales that fell short of analysts' estimates, and the stock is now lower in after-hours trading. Joining us is Zach Warring. He is equity analyst at CFRA. He's got a hold rating on Nike with a price target of $95. Zach, when it comes to Nike, we know the Jordan brand is doing fairly well, but it's a premium offering, and Nike can't just take that and run with it completely. What is the growth story here? What is the growth strategy for Nike, given that quarterly sales fell short of estimates and revenues you expect to increase only 1% for the full year?
Yeah, it's a great question, and it's something we're asking ourselves, and we're going to listen for in the call. We're really worried that the company just doesn't have the next leg of growth, and we're just, the valuation trades at 25 times earnings. And it typically, over the last few years, it traded well above 30. But we don't think that valuation's fair anymore. We just don't see, significant double-digit growth from the company.
And of course, we've been talking about how Nike shifted its distribution to really focus more on its own branded stores and its own website and removing some of those third-party distributors. Now it's gone back in the other direction because it became clear that old rivals and new rivals kind of, sucked up the oxygen in its absence. How hard will it be to repair some of those relationships?
Yeah, we think, their strategy, I think, is still working. I think direct-to-consumer is still the way to go for them. It doesn't make up over, some of these other companies have 50+% direct-to-consumer revenue, whereas Nike, typically is, in the 30 to 40% range. So, we think that that's still probably the best direction for them. We think there's still room to grow there. When it comes to like Foot Locker and some of these other wholesalers like Dick's, we think, they're going to probably go back into those stores a little bit, but, we really think over the next 10 years, Nike's going to really expand that direct to consumer, push the e-commerce platform that they've built out. And we think that'll benefit their margins.
For whatever softness they're having right there on that direct to consumer side, I think most of us can agree it was obviously a very prescient when they launched that, ahead of its time, really. And it's obviously going to be a fixture. But as you know, Zach, it also has to do with the products they put out there, innovation, and the biggest criticism that we've heard from investors and to a certain extent from consumers alike is that it's just the same old stuff, man. When do we get, something that's a little bit, more tantalizing? Is that going to matter?
Well, that's exactly right. We're waiting on the call. We've gone back and forth from sells and holds over the past year or two. We're trying to figure out what's next for them. They've had these competitors, Hoka, and On Brand, and they've done really well. You've seen them grow significantly over the past few years, obviously from a, much smaller base. But, it's interesting. This is the first real time that you're seeing Nike really struggle with competition. I go out, I go for a run or I'm at the park, 50% of people are wearing Hoka now.
Yeah.
And overseas it's more On Brand, but it's very interesting. This is the first time you're seeing this from this company because for so long they were a staple growth brand. They were able to grow in China, which 3% growth just this quarter and for the year. It's not much. And so kind of what's next for them?
Yeah,
exactly right.
What's next? That is the big question. Zach, really appreciate your joining us. Zach Warring is equity analyst over at CFRA on the heels of Nike's disappointing earnings in that its sales missed estimates. The stock lower by 5.4% right now.
Do you wear these Hokas?
No, I think they're...
I saw you the other day you had on.
I have on, but I don't have Hokas. Hokas are really big.
Yeah, they're ugly. I don't quite get
I didn't want to go that far, but yeah.
No, I'll go that far because they're hideous. But what is Nike's solution? Did they just come out? They have the thick sole shoes. But I was going to ask, we didn't have time to ask them about acquisitions.
Yeah.
Too. I know they tried this with Converse and it didn't really work. And Cole Haan, I don't know if you remember.
I think they need to fix their own product first before they go out and buy someone else.
Yeah, good point. Yeah.
The issue is you just don't see the coolest people wearing Nike anymore, as Zach was saying. When you go running, everyone's wearing Hokas or Ons.
Yeah, that's true. Are they cool though?
I don't. Well, Anyway.
Katie Greifield's cool.
She is. Okay, there you go.
Yeah.
Here's how markets close on the day. Not much to write home about when it comes to the major indexes. Yet another day of modest moves. We're about to close out June with only one session where the S&P closed up or down by at least 1%. And it's been more than 300 trading days since we've seen a drop of more than 2%.
And a big reason why Bruce Bond was trying to pitch those buffer ETFs. A lot of people are concerned as to whether those gains could continue.
Yeah, but we did get a rally in treasuries across the curve thanks to today's $44 billion 7-year note auction, which saw decent demand, and that's kind of been the story all week long. This is close. Jinx.
On Bloomberg.
You got the last word. Just 2 months to go before the start of a new NFL season, but front offices are busy. Of course they are. They're turning to their spreadsheets and data analytics to help manage everything from player performance to salary caps. SumerSports is leading that effort. Founded by billionaire hedge fund manager Paul Tudor Jones and his son Jack, SumerSports brings a Wall Street mindset to the world of football. Here in studio, I'm pleased to say with more, is Lorrissa Horton. She is CEO of SumerSports, and Thomas Dimitroff, former general managers of the Atlanta Falcons and president of football operations at SumerSports. Welcome.
Thank you.
Lorrissa, let me start with you. You recently provided real-time analytics to 5 teams at the NFL draft a couple of months ago. So there are 32 teams in the NFL. The teams don't know who else has access to your data. But tell us a little bit about the analytics that you do provide the teams. Is it the same package of tools for each customer, or do you customize your offerings and create proprietary screens for each team?
So the offerings are customized to the teams and the team's needs. So the amount of data that is available is equal to everyone in the NFL, but every team has a different scheme, a different strategy, and obviously they're in a different position in terms of what salary cap they have available and what needs are. And so we optimize specifically for their needs, whether they should get from the draft or look to free agency. So everything is unique to their needs.
And you're focusing on the NFL, and that's where I want to pick up, because the NFL reportedly lags behind other pro sports leagues like MLB or NBA in tech and data analysis. Why is that, given this is the league with the most money behind it and the fewest games, so the stakes are incredibly high?
There are some challenges in football that are just different than other sports. When I think about computer vision, for example, the number of bodies that pile on top of each other is very different. They're not separated like MLB. And so being able to apply some of the AI and technology is definitely lagging. That's one side. The other side is, like you mentioned, there's only a few games. So every team is really strategizing for next week's game. It doesn't leave a lot of time for building out deep solutions. The front office is also seeing a lot of churn over years, and so making that type of investment is a little more difficult for the clubs themselves.
So, Tom, give us a sense here. I mean, she talks about the front office. So are we going beyond the general manager level, right? So this is going deep into the operations of the. How deep? Just give us a sense here.
Well, I mean, everyone from the owner to the president to the GM to the head coach, all over the last 3 years. To me, it's gone through the roof. Their interest. We continue to get feedback from everyone. Show us the way. Our league is evolving. Don't leave us out there. But everyone's a little bit concerned about jumping in there when they don't know how to deal with it. The more that we can educate and help along the way from a SumerSport perspective and the offerings that we're offering, I think these teams will feel a lot more
comfortable. But to Scarlett's point, too, about the use of data, I mean, of course, we've seen baseball really embrace this. Basketball, I mean, we just came out of the finals here, and I mean, you had an entire team in the Celtics that seemed to be based around data analytics here. And I am curious, I mean, given how, let's just say, particular coaches can be in the NFL, I would think they would be much more receptive to this, given that they want to have some sort of empirical evidence of what works and what doesn't.
Oh, there's no question. Our approach is not necessarily play calling at this point. It's about roster optimization, of course, where we focus on helping the GM and the head coach make the right decisions in free agency, in the draft, pull it all together, and provide what we think is optimization. And no one's done that before, and we think as a third party we can do some special.
But just a follow-up to that, too, because there are some people that say that there are a lot more variables in an NFL game in terms of what transpires on the field relative to baseball, which is a little bit more static, and basketball, which is on a much smaller plane here. So, I mean, when you approach these teams, on that, I mean, what can you tell them about how reliable this can be, given that football is just this sprawling sort of a game?
It is a difficult challenge. You have 22 people doing independent things, obviously towards common goals, but it is a challenge. And I think data for an individual is not sufficient. It's data across the entire group. And for every single snap, you can just imagine how much information needs to be evaluated and used in our AI in particular. So we are taking all of that into account, and we're giving feedback around what type of people are working, which ones maybe aren't, and where your challenges are in your depth chart, for example, in your grouping, what gaps do you have in each position? That's the type of information we're delivering to them.
So, Tom, there are lots of specialty positions in football. The quarterback role is super complex because he does so much, whereas a kicker is pretty straightforward. Do you anticipate the technology, the data, the analytics that you'll be offering will influence what teams ask of certain players, change their role to something more complex or more simple?
I think the more that we understand in the league about utilizing data properly, I think it's going to be a lot more intricate with the expectations and how we're going to dig into dealing with each position, which is important, which is an amazing thing. Why, we're on the road right now talking about how important it is with what we're doing with our leadership group, bringing on Lorrissa Horton, a star in her field at WebEx, doing amazing things with the collaborative platform, turning that into $1 billion company and bringing her on board with myself and Paul Tudor Jones, tech, football, and data. We think that we have a really strong group moving forward on all of this, of course.
It's a powerful combination. So, Lorrissa, the NFL is made up of 32 teams. You could say that's your total addressable market, but obviously there's college football as well. How do you anticipate they might use the data that you provide differently than how an NFL team might use it? What are their needs, and how is it distinct from the NFL?
So I don't know that they'd use the exact same data because a lot of this is based on actual film and actual activity, but all of the tools, the entire platform that we're building is definitely reusable for college. And so like you mentioned, that expands quickly, especially when we see the changes in NIL and transfer portal, all of the difficult challenges that they had is starting to change, very similar to what the NFL is seeing.
Yeah, we could even bring that down to high school teams or youth football leagues. The list kind of goes on.
Youth football?
Yeah, maybe.
Are you one of those parents?
I'm not, but there are plenty of parents out there.
Yes, there are, having gone through that. Thank you for that. Lorrissa, though, when we talk about the expansion of this business here, and to Scarlett's point here, where does that expansion come from? Is it just all of the teams using it or more frequency of use? Where is that business expansion?
So it's a combination of the number of teams as well as tools that we can provide for players themselves and understanding how they can improve. You're mentioning, do quarterbacks get better, or do you start to be more critical about what you pick? And if we can tell you, here are the things you need to change to get a little better, to get to the next level, this is the kind of analytics we can deliver down to the players as well.
We just have to ask you, Tom, one final question here about the headline that we just got about the NFL hit with a $4.7 billion damages in the Sunday ticket trial. The NFL says it will appeal the verdict in that trial, but this was a surprise that it even got to this point, right?
I felt it was a surprise. I was surprised because for the longest time, I was not watching that, right? I was in the middle of being on the field, not worrying about it. Only over the last 3 years have I been digging into how important that is. So, of course, there's so much discussion. I'm getting calls from a lot of different GMs and presidents asking me, what is your take on this? And I'm kind of right in between trying to follow to see how this is going to play out. I was actually back on my heels with this decision.
All right. Well, great to get your instant reaction on that. We do have to leave it there. Our thanks there to Thomas Dimitroff over at SumerSports and the former GM of the Atlanta Falcons, and Lorrissa Horton, the CEO of SumerSports. Thanks to both of you for being here today. All right, stick around. We're going to set you up for what to watch tomorrow, and it includes one big event tonight. This is Bloomberg. All right, well, the first debate of the current U.S. presidential cycle takes place tonight, a 90-minute debate between the current President Joe Biden and the former President Donald Trump. David Gura down in Atlanta right now, I think on the red carpet there, where the face-off is about to take place. All right, David, let's get to sort of the peculiarities of this event here. No audience members. I'm told that even you, a hallowed member of the media, won't actually even be in the room. Is that true?
That's right. So the debate itself will take place far from here. I'm in the Georgia Tech campus. It'll take place in the CNN studio, which is, I gather, underground. And in that room will just be the two candidates and the two moderators, Jake Tapper and Dana Bash. So it's much stranger and different than we've seen in these past election cycles. And it kind of harkens back to what we saw in 1960, really, when we had that debate between Nixon and Kennedy. So it's very stripped. It'll be just the two candidates. And then talking about the peculiarity of the rules, the candidate will have 2 minutes to answer a question. If he exceeds that amount, the mic will go out. So we won't be able to hear that person continue to talk, although certainly the other candidate will be able to. So there is the potential for some awkward moments there as well. But certainly not having an audience is going to be a challenge, and something I think people are going to be interested to see, sort of how each of these politicians deals with the fact that they won't have the reaction from the crowd to feed off of.
So there have been a lot of reports that President Biden has been carefully preparing and training and, getting ready for this particular debate. What about former President Trump? What do we know about his preparation?
Yeah, I spoke with a Democratic strategist today and a Republican senator, Rob Portman, former Republican senator who worked on a lot of these preps for previous candidates. There is a traditional way to do this. That is, you go to some place isolated. President Biden has been at Camp David, going through a lot of policy briefings, even running some mock debates. Rob Portman used to play the role, I think, of Gura and Lieberman, John Edwards in the course of doing all of that. Donald Trump has not been doing that. He's been on the campaign trail. He's had a few rallies. We gather he's been talking with policy advisors in kind of an informal way, and he'll bring that to bear on the stage tonight. But a real contrast in terms of approach, and we'll see sort of how that plays out during the course of the debate.
I am curious about sort of what happens next, David. There's been a lot of talk here about the support that the former President Trump either has or doesn't have, particularly among some of the folks you would think would be behind him. I know a little bit earlier we had a chance to hear from the governor of Georgia, Brian Kemp, of course, who was inadvertently sort of dragged into some of the election fraud issues coming out of the last campaign. What did he tell you?
Yeah, I got a chance to talk with him on the floor of the spin room behind me. So not a red carpet, but this the floor of the basketball arena here at Georgia Tech. And, you know, we talked a lot about that. Sort of his, you know, he did not vote for Donald Trump in the primary. He admitted that on CNN last night. I asked him just about how the party is going to coalesce around Donald Trump. He seemed very confident that's going to be the case. And his counsel to the former president tonight is to really focus on economic issues, to kind of move away from broader topics about what happened years ago or talk about democracy. Really, it's pocketbook issues he thinks the former president should be talking about tonight. He, again, was optimistic that once we have this kind of presumptive nominee move into the official nominee status after the Republican convention, we're going to see the party coalesce around him. All right, David Gura on the ground out there in Atlanta, though not at the debate stage itself, keeping the media sequestered. He will have full coverage of that 90-minute debate, which kicks off at 9 p.m. Eastern time on CNN. We will have full coverage, though, right here on Bloomberg Television, starting just ahead of that. Be sure to tune in for that as we break down all of the action that happens on the debate stage tonight. Meanwhile, some of the other things to keep an eye on over the next 24 hours, it could be potentially moving the market. That includes the presidential debate tonight against Joe Biden and Donald Trump. And then tomorrow, Scarlett, we're still on watch for more Supreme Court rulings.
Yeah, the Supreme Court today actually announced that it is curbing the SEC's ability to press complaints before in-house judges. So that was just one of the rulings that came out with. We're on the watch for more. Monday scheduled as a new opinion day. So, I don't know that it'll move markets, but it certainly will move a lot of people before the elections.
And maybe some of those rulings might actually come up in the debates tonight here, as some of those issues have become election issues. Meanwhile, the economic conditions are still front and center for investors, and we get another data point tomorrow morning.
Yeah, a pretty big data point. Core PCE, this is the data point, this is the inflation metric that the Federal Reserve really favors, looks at very carefully. And right now, the consensus estimate is for an increase of 2.6% versus the same time last year for the month of May. Again, this is how the Federal Reserve judges whether monetary policy is too restrictive or not, in addition to looking at employment.
Yeah, we're also going to get some sentiment data as well. It'll be interesting to see how this affects markets and, more importantly, the second order effect to the Fed. And we got another presidential election out there, this time in Iran. Scarlett, who you got?
Well, actually, I don't know. I don't know who the people are running.
All right. Well, we will keep an eye on that. Of course, bring you those results. Scarlett and I will be back tomorrow right here on The Close on Bloomberg.